1. Investing without a plan. Many beginners enter the stock market hoping to make quick money. But without a solid plan, they often end up losing more than they gain. Let's talk about why investing without a plan is one of the biggest mistakes you can make, and how to fix it. Imagine going on a road trip with no map, no destination, and no idea how much gas you need. Sounds risky, right? Well, that's exactly what happens when you invest without a plan. You're making decisions based on emotions, hype, or random advice. Instead of following a clear strategy. When you don't have a plan, you're more likely to chase trending stocks without research. Panic sell during market downturns. Hold on to bad investments for too long, hoping they recover. And worst of all, you never truly build wealth. So, how do you avoid this mistake? Start with a clear investment plan. Ask yourself, what are my goals? Am I investing for retirement, financial freedom, or something else? What's my risk tolerance? Can I handle market ups and downs? What's my time horizon? Am I investing for 1 year, 5 years, or 20 years? By creating a well-defined plan and sticking to it, you'll avoid emotional decisions and set yourself up for long-term success. Want to learn more about smart investing? Subscribe now for more insights and strategies. Second common mistake, chasing hype and trends. You've seen the hype, social media, news, and influencers telling you about the next big stock. It feels like everyone's making money. But chasing hype and trends can be one of the biggest mistakes for beginner investors. Here's why. It's easy to get caught up in the excitement. A stock is trending, everyone is talking about it, and you don't want to miss out. So, you buy in at a high price. But then, suddenly, the hype fades, and the stock crashes. Now, you're left with losses. Chasing hype leads to bad investment decisions like buying at the peak, just before the stock drops. Ignoring company fundamentals, investing in a stock without understanding its actual value. Crossmark, panic selling. When the hype disappears, you sell at a loss. So how do you avoid this mistake? Simple, do your research. Look beyond the hype. Check company fundamentals, financial health, and long-term growth potential. Think long-term. Instead of chasing trends, invest in strong, stable companies. Stay disciplined. Just because a stock is popular doesn't mean it's a good investment. The best investors don't follow hype, they follow a strategy. Want to learn more about smart investing? Subscribe now for more stock market tips. Third mistake, lack of diversification. Ever heard the phrase, don't put all your eggs in one basket? Well, in the stock market, ignoring this advice can cost you big time. One of the biggest mistakes beginners make is lack of diversification, putting too much money into just one stock or sector. Here's why that's risky and how to fix it. Many beginners believe in a sure thing, a stock that can't fail. They put all their money into it, only to watch it crash due to unexpected news, earnings misses, or market downturns. Here's what happens when you don't diversify. If one stock crashes, your whole portfolio suffers. Market shifts can wipe out entire sectors. You miss out on steady gains from different industries. Without diversification, you're taking on unnecessary risk and exposing yourself to huge losses. So, how do you fix this mistake? Diversify. Invest in multiple sectors: tech, healthcare, energy, consumer goods, and more. Mix assets, stocks, ETFs, bonds, and even real estate for stability. Consider index funds, a simple way to get exposure to a broad range of stocks. Diversification helps protect your portfolio from big losses while keeping you on track for long-term growth. Don't gamble on just one stock, spread your investments and build real wealth. Want more smart investing tips? Subscribe now and start investing the right way. Mistake number 4, trying to time the market. Imagine if you could buy stocks at their lowest price and sell them at their peak every time. Sounds amazing, right? But here's the truth, even professional investors can't perfectly time the market. And yet, many beginners make the costly mistake of trying to do just that. Here's why it doesn't work and what you should do instead. Many beginners think they can wait for the perfect moment to buy or sell stocks. But in reality, markets are unpredictable. If you wait too long, you might miss the best opportunities. If you sell too soon, you might miss future growth. If you try to time dips and peaks, you'll likely end up chasing losses instead of gains. Here's what happens when you try to time the market: you get stuck on the sidelines, waiting for a dip that never comes. You sell too early, missing out on long-term growth. You stress over daily price movements instead of focusing on long-term gains. Even the best investors can't consistently predict the market, so why take that risk? So what's the better strategy? Instead of trying to time the market, follow these proven methods: dollar cost averaging, DCA, invest a fixed amount regularly, no matter what the market is doing. Think long term. The market always has ups and downs, but it trends upward over time. Stay consistent, keep investing, even during market dips, because that's when you get the best deals. Stop stressing over when to invest, just focus on investing consistently. Mistake number 5, letting emotions control decisions. Fear and greed, the two biggest emotions that can destroy your investments. Many beginners let emotions drive their decisions, buying when stocks are booming and selling when panic sets in. But here's the truth: emotional investing leads to big mistakes and lost money. Let's break it down. When the market is soaring, people rush in, afraid of missing out. But when prices drop, they panic and sell. This emotional cycle repeats over and over, causing investors to buy high and sell low, the exact opposite of what you should do. Here's what happens when emotions take over: fear leads to panic selling at the worst time. Greed makes you chase overhyped stocks. You make impulsive moves instead of sticking to a strategy. The result? You lose money while patient investors profit. So, how do you avoid emotional investing? Stick to a long-term plan, don't react to short-term market swings. Use stop-loss orders, protect your portfolio without panic selling. Ignore market noise, the media thrives on fear and hype, don't let it control your decisions. Stay disciplined, invest based on research, not emotions. The best investors stay calm and consistent, and that's how they build real wealth. Want more tips to master the stock market? Subscribe now and start investing smarter.